Thank you, Hernica. Our competitive strategy focused around a high SQ rating with more models than our competitors. On average, in year 11 through 18, we had an SQ rating of 1.2 stars above the North American market average and 0.17 stars above the Europe, Africa, Asia Pacific, and Latin American markets. We wanted to focus on having a high image rating, so we focused on corporate citizenship, offering us second place in the industry 4 years in a row and a Corporate Responsibility Award. Celebrity endorsements were also a focus of ours, and Best Trends managed to have at least one endorsement every year except for year 13. We tried to keep our prices within 5% of our average price in each market for our shoes. And finally, we focused on using all retail outlets available to maximize availability to consumers. In year 18, we averaged 36.7% more retail outlets used than other companies. Our competitive strategy for internet sales used the same focus on high SQ rating over competitors. We also managed to have 29.4% more models offered in the internet segment in all four markets. These two strategies, coupled with free shipping, allowed us to offer a high-quality shoe at a competitive price. We kept our price higher than average in the first 7 years and decided to lower our price closer to the average price and found we could still afford even a lower price. This will be our strategy moving forward. Similar to our wholesale strategy of having a good image rating to help sell more shoes, once again we use corporate citizenship initiatives and celebrity endorsements to increase sales. We found our private label strategy was varied throughout the simulation. We began focusing on private label sales but quickly lost focus in year 14 through year 17. We did not realize the market share impact until we lost those sales. Towards the end of the simulation, we realized that making minimal profits in the private label sector was worth the gain in market share we received in our selected markets. Most of the time, we looked at the previous year's supply versus demand and looked to focus extra capacity in markets that were not being fully supplied. We also compared this to the markets that we could likely lower our price below the previous year's lowest price without losing money per pair. When starting to grow capacity, we did not see a reward great enough to risk building in a new market. We elected to grow and continue to produce in 2 markets rather than 3 or 4. We focused on using superior materials over standard materials because we believed that our competitors would focus on standard material usage, creating a lower price for superior materials determined by the base use of each material, which paid off by superior materials being less than $12 in all but 1 year. We also ran our plants to 110% capacity, expecting any unwanted wholesale products would be sold in private label. Finally, we upgraded both plants to grow our SQ rating by 1 star with equipment upgrades. We believe this would save us money in producing higher quality shoes with a one-time price and continued reward. Our workforce compensation strategy included annual salary increases for both North America and Asia Pacific to increase productivity, 1% and 2% respectively. Our incentive pay per non-rejected pair was held steady for both production markets as well, 70 cents per pair for North America and 50 cents per pair for Asia Pacific. Our best practices training differed greatly for both markets. We found it changed productivity more in North America, which led to $2,000 per worker compared to $1,450 per worker in Asia Pacific. Overall, we found incentive pay and training was more important to North American workers than annual salary was for the Asia Pacific plant. We didn't have a strict policy on dividends. We typically added dividends when our net revenues were projected high enough to have additional cash to pay out dividends. Moving forward, we have elected a policy in order to reach 35% return. We did initiate an investment to increase capacity during year 16 and 17. In year 16, 70% of debt was used, and in year 17, 50% of debt was used to construct the new plant. A total of $105 million was sourced through loans. Instead of issuing additional stock to meet these ventures, the difference was financed through the current year's sales revenue. Our continued success with our credit rating made it easy for us to borrow money and has yet to falter even with our newly secured debt. We continually repurchase stock totaling 1.35 million stocks to improve return on equity for our shareholders. To compete in North America with our competitors, we will focus on lowering our prices in internet and wholesale segments. We will also increase our rebates and retail support. The advertising budgets for other companies are out of reach, so we will focus on increasing our celebrity appeal to combat that. In Europe, Africa, once again, we will focus on lowering our prices in internet and wholesale markets. Again, we will increase rebates and retail support. In this market, we will increase our advertising budget and keep celebrity appeal steady. We will also look to enter the private label segment after more capacity is available. In the Asia Pacific market, we only see a need to lower our prices in our internet segment. We do, however, believe increasing our advertising budget and retail support will help us be more competitive. Our Latin America strategy will mirror that of our Asia Pacific market. Quite a few lessons in this business strategy game. We initially believed a higher SQ rating and higher price would compete well because everyone would go for a low price. Well, we quickly realized that even with the high SQ rating, we needed to be competitive with our prices. Finally, in year 18, we realized how much repurchasing stocks affects ROE. After the simulation, we finally learned that our production plan wasn't the best it could be. Our upgrades did not meet our demands, and we should have purchased capacity earlier in the simulation. We also should have upgraded our plants earlier to get a jump start on demand. Finally, we realized that building capacity in new markets costs the same as current markets, and we should have built in new markets to negate losing money in exchange rates. Advertising budgets quickly skyrocketed among our competition. We learned that celebrity endorsements can cost less per pair than increasing advertising budgets in each market and can combat the high advertising budgets. Finally, we learned that even though market demand was high, we didn't have to fully supply the wholesale and internet demand. We could have focused on offering private label sales and then used the rest of our capacity to meet wholesale and internet demands as best we could. Moving forward, we would look to increase our dividend payout until we reach paying out 35% of our earnings to shareholders. We will look to build capacity in new markets so that we can compete with other leaders as well as battle against exchange rates. To overtake our direct competition, we will look to be more competitive with our pricing strategy, especially in our internet segment. After seeing a huge increase in our image ratings surrounding our corporate citizenship initiatives, we will continue to invest in these programs and look to increase our support even more. Stock repurchases will continue to grow year after year to continue to increase our ROE. And even though we look to build in new markets, we will also keep a close eye on the movement of exchange rates. Our initial builds in new markets will not be enough to meet demand, so exchange rates will still play a role in our distribution strategies.